Welcome to our third part of our webinar on increasing equity value. Today, we're going to be talking about optimizing capital structure. Our first series on this part was on organic growth. Second was optimizing your back office, your operations, everything you need to make sure that the foundation of your business is ready to grow. As an introduction, I'm James Graham, director out of our California office, been with MarshBerry for 10 years, largely focused on strategic consulting and sell-side M&A advisory.
And hi, James, it's good to be here. My name is Eric Hallinan, and I'm a managing director here out of MarshBerry's California office. I've been with MarshBerry for about 15 years and also spend most of my time with investment banking and consulting activities focused mostly on sell-side advisory work.
For those of you that are new to MarshBerry, by quick introduction, we've been around since 1981, focused on insurance brokerage, more recently on wealth advisory and accounting and other professional services firms. We have 6 offices in the US, 3 in Europe for a total of 9 offices. And to show that we practice what we preach on some of the things around capital structure, currently set to join Lincoln International. That deal is been announced, not yet closed. You can reach out to us individually if you want to know more about that. We also provide a suite of services to help firms go from cradle to grave, whether that be consulting services as you think about how you're going to grow your firm and everything we talked about in this webinar over the last 3 parts, or whether that's realizing the value through a sale, whether that's growing through you need buy-side support, whether that's taking on capital, which we're talking about today, either that debt or equity, whether you need help perpetuating. If you want peer exchange, you want advice from your peers, we facilitate as peer exchange network. Eric and I both facilitate 2 groups twice a year. They get together in person and they connect throughout the year. We have an agency network to let you get better carrier access depending on your markets. We have the largest agency network in the country. And undergirding all of it, we have the largest market intelligence in the insurance industry for insurance distributors. We get the largest data set of reviewed financials that go into that data set. So pathways to increasing equity value. So as I said before, this is part 3 of the series. The other 2 are recorded. You're welcome to go back and follow up on those if you want to follow the through line through pathways to increasing equity value. Our lens and bias at MarshBerry is how to help clients, which are agency owners and shareholders, to increase the value of their businesses. So what we're going to focus on today is the life cycle from founding or ownership through to either selling externally or becoming a legacy type business that lasts for generations and generations. And what does that look like?
Yeah, capital structure is something that needs to be looked at periodically. We'll talk more about this. It's not something that's just set in stone. And so and it always should have that forward-looking concept attached to it.
So one thing we've talked about in each one of our series is why focus on growing equity value. It's not just about the money. It actually allows your firm to accomplish everything that you want your firm to accomplish, whether that's serve your clients better, provide your employees with better opportunities and rewards, grow your personal wealth, go after certain markets, have certain experiences, like leave a legacy. Whatever your goals are, the more you run the business correctly and the more you would align the benefits of that business with the right shareholders and stakeholders, the more equity value grows and the more optionality you have. So it's not a increased value at all cost type conversations. Everything that you value is likely linked to equity value at the end of the day.
And this being part 3 in the series, the first part was focused on organic growth. The second part was focused on operational efficiency. Both of those things have a direct impact on the potential profit or cash flow of the business. And clearly, equity value or valuation in general is a function of increasing and growing and summing or adding up the cash flow of an organization or the expected cash flow of an organization. What we're diving into a little bit more deeply today is how you can enhance that by optimizing your capital structure.
So first thing I want to talk about is what is capital structure and why does it matter? So the most basic thing here is that your capital structure is essentially your debt and equity capital that you use to grow the business. And what you want to do with your business is have positive returns for that for the equity holders, and you want to have the right amount, the right financing from the right sources to accomplish the goals and initiatives that you have. And so why it matters is if you are spending money to grow your business and you're getting it from the wrong sources or inefficient sources, or if the return to the equity part of it isn't sufficient, then you are leaving a lot of value on the table. You're hurting your growth, you're hurting your opportunities, and you're not creating something that is going to give you the right returns for your investment in the business. So we're going to be focusing on enhancing shareholder returns. We want to create leverage so that you have flexibility. We want to make sure that your firms are resilient so they can be dynamic as your firm grows and as market changes. And you want to be able to enable whatever your strategic growth initiatives are. So what is it? It's a strategic mix of debt and equity that funds your business. So I'm gonna give a little colloquial thing that I've seen in the market. The lowest gross firms on average in our experience are the firms that they proudly tell us that they're a single owned business. We have one owner, 100% owned, and they have no debt, and they never had any debt. It's a classic thing that we hear all the time. No debt, we own 100% of the business. Sometimes you find people have been able to grow it successfully with that being true, but oftentimes it's a recipe for we haven't reinvested in the business, we haven't grown the business, we haven't brought on new shareholders or stakeholders, and we're stagnant. The next most common thing they say, going back to the first session of this three-part series, is our organic growth rate is 10% per year, and you look at the revenue and it's $3 million for 10 years. You're like, no, your new business is 10% and you've never actually grown. And so this is something we want to challenge our clients with, is when you look at growing your business, it is going to cost capital, and you're going to want to think through how do you match the right capital to the right returns that you need to grow and evolve your business.
One key factor here is most firms, when they start and as they evolve early in their life cycle, debt is not a strong or readily available option. But as you think about this and plan ahead, again, remember we said this is a forward-looking concept. We're going to talk about how you might use debt and when it becomes appropriate, and how you think about your projections going forward when debt might be appropriate. But early on, we're mostly talking about being very stingy with our equity and driving most of our capital structure with equity.
So to that point, let's walk through at a high level. And this whole presentation is very high level and summarized. You can always contact us if you want to go deep on where you fit in some of the nuances between these big steps. But if you take a step back and think of a cradle to grave of what goes on with a growing business, and we've seen this with so many of the large businesses in our spaces that we cover, often it starts out with, not every time, but often it starts out with an individual entrepreneur that has chosen to set up a shingle and start their own business. And what they've done is, for some period of time, single ownership and at this stage, probably no debt is fine. But they get to a level where they want to grow it. And generally, we're going to see this somewhere between 5 and 10 million in revenue, depending on the firm, sometimes a little bit more. They're going to need to expand the ownership pie to ensure that they have additional leaders whose capital they're driving benefit from align with the firm. And that's where you're going to see it move to a partnership model. When Eric says be stingy with the equity, the important part there is you're not just giving equity away at this point to anybody. It's a privilege to become a shareholder at firms like this, or firms in general. And you want to make sure that the people that brought into the partnership model exude the values of the type of individuals you want to be partners with, and are in it for the long run, and are driving excess value to the firm. So the first thing to think about from a capital structure perspective is, what human capital needs to own equity in this business so they're aligned with the long-term benefits and growth and profitability of this enterprise.
That's a key point, and we'll actually touch on that a little bit more in a few pages.
Right, and this is where most brokers live, is in somewhere between this individual owner and partnership model, evolving from there. At a certain size, and this is going to happen somewhere between sort of 20 to 50 million in revenue, sometimes a little bit more. Again, all these things can fudge based on the goals and life cycles and what an individual firm is trying to accomplish, there is going to be a need to grow, even to keep growth rates at a level that's attractive to return proper returns to shareholders. There's going to be a need to take on external capital, and we'll talk about some of the reasons why, uses of that capital in a minute. And that's going to come from either debt or equity partners. At this point in an agency's life cycle, the decision making between what type of capital you take on actually gets pretty complex based on what you're trying to accomplish and what your goals are. And so what we see is debt at this, most firms get to this size with relatively low debt levels. So they're pretty bankable, and they have the ability to take on debt at attractive rates in order to exercise on any number of strategic plans. If they want to be a little more aggressive, that's where equity comes in. The equity is phenomenal if you're very, very successful, and phenomenal if you fail. But it isn't great like in the middle if you want to have sort of like a middle tier growth perspective, because equity shareholders generally are going to demand higher returns than many individual agency owners may feel is enough for them to be happy. Debt gives you more flexibility on how you operate the business. Obviously, tons of risk on the downside if you don't operate the business correctly. Now, insurance brokers tend to be pretty stable, so the risk is mitigated versus other types of businesses. But we're going to go into a little more detail. Finally, and we're jumping ahead, there's so many like interim little things that happen in between these different phases. But finally, if you're going to be a legacy business that lasts 100 years, and when I say 100 years, not 100 years and doesn't grow and it's just a local agency, but like 100 years and is a regional platform, billions of dollars in revenue, eventually you're going to have to be attracted to the public markets. And we've seen firms do this in a number of different ways. More recently, we're seeing firms sell to strategically publicly traded firms in order to accomplish this path. But there will be a large number, we believe, and this is not information that's set on anything factual, but we do believe there's a number of firms that will be seeking to IPO in the next few years as they go to their final stage of permanent capital in the public markets. There are some alternatives in the private markets, but they're not as permanent as a public market structure. So what do you need to spend money on, right? Where is the right way? What are the things that you might need to take on outside capital in order to increase your growth? So if you take a step back, an agency is a low capital intensive business. When we share average debt loads and our valuations, we put it at like 90 equity, 10% debt. You do not need a lot of debt to operate an agency. You can use debt and equity, though, increase from what you have to grow faster, but you have to have some place to deploy it. So the areas that you can use it in an insurance broker, you can use it for technology. When we say market expansion, that's going to loop into producer hires in new markets or potentially buying agencies in new markets, standing up offices inorganically or organically. So you can use it to hire new sales staff. You can use it to hire staff in general. You can use it for M&A, which we've already stated once. It's probably the biggest use of capital in this space is through mergers and acquisitions. And that allows you to not just increase market expansion via geography, but potentially allows you to add ancillary and complementary services, bolster your revenue with carriers that have better underwriting criteria and contingency ratios and things with carriers. So there's a lot of benefits from M&A that go under a lot of different things that you're trying to accomplish. You may use it as a way to dividend shareholders in a more efficient way. So you might not have the cash on hand. You need to get some liquidity to shareholders for whatever reason that they have, or you guys have as a shareholder group. It's an effective way to do that. You may also use it, this is another common thing, for as you're trading equity internally and you're aligning the capital of your future leaders and you're buying out the capital of your retiring or legacy leaders, you may need to bring in capital to help facilitate that entire process. And this is a common thing on almost every large agency with a diversified cap table of any kind, that they're using debt either internally or externally to allow them to buy and share shares as they continue to grow.
The examples in the marketplace that you can kind of take a look at and kind of view as benchmarks. If you think about the private capital backed insurance brokers that are out there, there's at least 40 or 50 of them that you could name. They're household names. they are strategically using capital, both equity capital from the private equity firms that have invested in them, as well as debt. They take on additional debt and have a mix of equity and debt, and they use that to fund M&A for the most part. They also fund technology and human capital and other things with that strategic use of capital. But what that allows them to do is to efficiently use external sources of funding to accomplish major strategic initiatives much faster than just funding things through their own cash flow. And it accelerates the growth and puts them on a path to meet their various ROI objectives and stuff like that.
Yeah, and we're not going to dive into it in this particular webinar in detail, but we could have conversations offline. Also, additional debt, and this is a well understood concept, juices equity returns if you can get the growth out of it, because it shrinks the amount the equity owns and then of the entire value. And as the equity value increases, a disproportionate amount, all the equity upside goes to the equity holders, not the debt, because the debt's fixed. So one of the ways that these private equity-backed firms are generating large shareholder returns is through the use of above average leverage ratios. So as you think about using your capital, whether it's the cash on your balance sheet, the cash flow of your agency, external equity, external debt, the first thing you need to start with is, what am I going to use it to do? And we just talked a little bit about that. And we need to talk through, how much do we need? When are we going to deploy it? And what's our expected ROI? So if you have a really high ROI, expected ROI, you can use more equity capital. Whereas if that ROI comes a little bit lower, you may want to use a little bit more debt capital. Debt reduces your overall, a mix of debt and equity. Equity is the most expensive, so adding debt reduces your overall cost, but it's definitely a balance between risk and reward. A lot of what we do for our clients that are looking to deploy capital is help them think through that question. What are they trying to accomplish first? How much they need to accomplish it? When will they deploy the capital? And what is the expected ROI? And part of that expected ROI calculation is, what is the underlying risk, right? So if you're going to hire 10 producers, that is riskier than buying an agency on balance, assuming you do those things correctly. Now, the return on the hires, if they're successful, is higher than the return on the agency, again, on balance. These things can be different by specific scenarios, but just to help kind of give some illustrations of how this conversation goes.
So this point, assessing opportunities and prioritizing the initiatives, managing the the investment that you need and the expected ROI, this is probably the most critical step as you think about planning for your capital needs. And this is the thing that when you're ready to go out and seek the capital, every single potential capital provider, whether it's a debt provider or an equity provider, is going to want to see the detail behind this. They're going to want to see, what do you want to use the capital for? How much do you need and when am I going to get my money out? And when am I going to get a return on it? And I need to see it not just in hopes and dreams, but in very minute detail.
And one giveaway that we don't have in this deck, they're also going to see, how much skin are you putting in the game? There's not a world where they want to provide equity, you're taking the excess cash flows and stripping out of the business. So it's important that you're aligned with the risk of whoever you're partnering with. When we talk about analyzing the end of this thing, expected ROI, and we talk about how do we analyze expected returns, right? So we need to determine, if you're going to do something, if you're going to hire producers, buy an agency, invest in a technology platform, if you're going to bring on a partner, and you're going to expand your equity, you're going to give them some of your equity, which again, we use the word stingy early on. So you're going to part with something very valuable. How do you determine if that's worthwhile or not? The first thing you need to think about is, what is our required minimum return on that investment? What are the alternatives to those returns? So is your firm set up to hire producers and you're going to do a good job of that, or is that a waste of capital because of the way your model's set up? Can you do an M&A transaction, or is the cost prohibitive because it's not accretive to your model? You also have to think about, what are the internal representations you made to your shareholders. If you have an internal stock price that you're managing against, M&A becomes very prohibitive if that internal stock price is way below the market value. And so that's something we have to talk about. If, so example, like if you have an ESOP or other things, it's not that it's automatically, detracting from value, but it could be if your alternative rate isn't there. And then we have to think about what are the risks with each, what is the potential downside? So often when we do a cash flow model and we're helping a client think through deploying capital, it's okay, if things go well, this is our baseline return. What's the sensitivity analysis on things don't go well? What if things go really well? And what are the things operationally you can do to kind of control those outcomes and reduce your risk? And based on that, that's going to drive how much debt, how we fund the project.
Some of this gets into the deep parts of like corporate finance and finance education, and is a little bit beyond the scope of your typical insurance broker. And that's okay. That's why you have advisors and CPAs and other people that help you with some of this stuff. And just focusing on the concept of determining a minimum required return, you may have heard the term cost of capital. That's really the hurdle that you're trying to get over. And the cost of capital is kind of a deep concept in finance, but you can actually talk to people and get advice around what is your cost of capital? What is my cost of debt capital versus the cost of equity capital? And how do I manage getting over that hurdle? Those are some of the questions that you want to be able to talk through.
Yeah, and just to throw out sort of a controversial thought for those listening, there is a natural cost of capital for you holding your equity versus selling it any time. And as the manager of the business or as the CEO of the business, if you didn't own equity and you were measured as the CEO on increasing equity, if you can't keep up, if that delta gets worse over time, then you're better off from a purely financial perspective liquidating the investment. And it's not a recommendation. We'd have to know more about your business, but it's good to know what those deltas are so that you manage the business so that you're keeping up and not actually becoming poorer because you're outperforming what the market is doing.
We have a client that refers to that as the death line.
It's a good one. So we're going to walk into balancing debt and equity and how do you decide what's going on? And we've talked about this concept a little bit already, but equity involves giving up a share of ownership, right? You are giving up some level of control. Now, there are multiple ways to do that. Equity is a lot more complicated than debt because you have actual common voting shares with a bunch of legal rights that you're going to be a true partner. And most agencies are going to live in that world because when you're in that 10 to 30 million revenue range, getting more complex than that probably isn't the right thing. There are also, and we're not going to talk about it too much, but there are also compensation tools that are equity-like that allow you to bring people onto the economic consideration without the headaches of having a legal partner. And that's something we see a lot of for certain firms that the owners may say, hey, we're not ready to necessarily do a full diversify or distributed cap table, but we do want to share in the economic upside. So that's another option. And then there are, when you're larger, and actually we see this more, preferred equity is normally a concept that actually doesn't show up except on if you're going to take on a minority investment, which means you have to be larger, probably more than 30 million in revenue. There are exceptions. And or you're much larger, you're billions in revenue or close to that, and you need even more capital because you've already exhausted the sources of capital that you have today. So preferred equity on the minority side, probably makes a lot of sense. When you start seeing preferred equity in the cap tables of large brokers, that's signaling that there's not as much economic upside for common shareholders as there otherwise would be, because preferred equity has a minimum return and it sits above common shareholders in return. So if the preferred equity's minimum return is 8%, which is a common 8% return, and the firm's return is 5%, that means that preferred's still going to get their 8, but the common's going to get much less than 5, even potentially 0, depending on what the ratios are there. So it's important to look at these things and say, okay, as a growing agency, you're going to want to focus on common. There's a world preferred for minority private equity shareholders who don't have a say on your board. That's fine. And then when you see pref on the other side, that normally means that they've got to the point where they're a little bit more capital distressed. That's not true all the time, but they're having more capital and they're going to that they need outside of 7 times leverage and whatever equity stack they had. So it's a lot of excess capital, and that's going to pull away returns from common shareholders. So the point of this is just to talk about the different types of equity. For our average client, they're going to live in a common equity or equity-like world, and that's where most of the time we're going to be recommending clients stay.
That's a good point. And there are different variations of how common equity can be structured. We don't often recommend to have different classes of equity, but you can have different classes of equity. The way you manage corporate governance, so the decision-making of the organization can be something that is separate from the common equity ownership. You can have contracts or governing documents that stipulate, planning and decisions are handled by the board, and the board is a subset of your common equity holders. That's just an example. This can all be managed in thoughtful ways, so you're not just beholden to, we have 10 people and they each have 10% ownership, and that's how we decide everything. So you can actually segregate away from that. And that's also a separate piece from what James was talking about as it relates to the economic aspects of sharing in equity, because you can have synthetic equity to manage some of those returns and get them out of the corporate governance altogether. So different tools that you can use, but this just summarizes it in a very succinct way.
So what are the potential benefits of equity capital? So let's say you give capital you bring a producer on as a shareholder is one type, or you bring in outside capital. What are the drawbacks, and when's it best to use it? The benefits are you do not have a set liability you have to repay. You don't have a situation where if you have to liquidate the company for whatever reason, that you have a liability that's going to take your house away. Like the liability of the equity is contained within the four walls of your agency. So that's a protection. And you do get a partner. And so one of the key things when we talk about outside equity capital, if you're going to go bring in private equity or family office or even an individual investor that you think is important to be aligned with, picking someone with expertise in your business can bring a ton of value to the future beyond just the money. So that's one of the things you definitely should be thinking about. It's not just purchase price or the terms they're willing to take, is what else they bring to the table. They may have, you may partner with a family office as a portfolio of companies. You could write all those companies' insurance. There's all kinds of benefits that are in addition to just the price or the use of the capital when you think about that. When you bring on a shareholder, what's the benefit of using equity versus an equity-like instrument, or versus, not bringing them on as a shareholder? It aligns them to the growth. It aligns them to everything you care about. Gives you more control over comp. It gives you better restrictive covenant protection in certain states. So it aligns that person and it reduces the risk of them becoming a competitor, which we've seen a lot when you get a young agent who's very successful and the firm that grows them doesn't cut them in on alignment long term. This business is portable, and often they will find a new home, and often that'll be their own agency. The potential drawbacks is it's very expensive. We don't recommend bringing in at least outside capital unless you think you're going to have really high organic growth rates, or not organic, I mean just growth rates in general. Generally, you've got to have a path where your ROI on that equity is going to be over 20% per year. Otherwise, it's very questionable if you should be bringing it on. It's going to dilute your ownership. Depending on how much you bring on, it's going to reduce your ability to make decisions. And they're locked in. They're sharing the value forever. Or for as long as they're a shareholder, right? They're in the cap table. If you grow 100% over 5 years, you double over 5 years, their value potentially is doubling over 5 years. And that's, if you take that as an interest rate, it's over 20% per year that you're paying for that capital. So again, the biggest drawbacks are shared decision making and sharing of the upside if you're not deploying in a way that is useful. When it's best used, higher risk investments, large investments, like you're buying a larger firm, very accretive investments, you're using it to align people long term. You want to use it for things that have high return or have high risk, and higher risk than something's, that's normal. So for example, if you're buying $1 million revenue agency, local agency, you're going to roll it in and you're going to pay 1.5 times revenue for it. You don't need equity capital. You could get a loan and probably do that most of the time. Now, maybe when I say that you don't need, details matter. On average, you could probably do that yourself. If you're paying 4 times revenue for that, and you're like, okay, my upside is maybe I trade for 5 times revenue. I'm just using, these are just made up numbers. You probably start to think about, if I'm going to do this on a serial basis more than once, and I'm gonna produce 20 to 30% valuation accretions every single time I do this. That's when equity partners start to make more sense than a one-off, or when you're able to do deals at a more attractive price.
One thing that I'd like to add, talking about the potential benefits, when you're thinking about bringing on external capital, an external investor, it don't discount the idea that they know what they're doing, and that advice that you're going to get, that additional expertise, actually will help increase the potential growth. Many of these firms that are professional investors, private equity firms and the like, they know how to scale businesses. And a lot of independent agency owners and independent wealth firm owners, they don't really know how to scale from 15 million to 30 million to 50 million to 100 million. And that's a hard skill set to learn from others without somebody being involved, rolling up their sleeves and being an active investor next to you. So that's an added benefit that's hard to quantify, but definitely real.
And the other thing about equity capital is, if you have a major shareholder that needs liquidity, and let's say you're 30 million in revenue, your enterprise valuation is 150 million plus, and you need $50 million to perpetuate a shareholder, sometimes an equity capital partner is your only real option. So there is size, like when you get to certain sizes and the amount of capital you need, debt can get exhausted fairly quickly. And high leverage ratios are not really accessible without a private equity partner. So there's certain levels of debt that you're not able to get without private equity sponsorship, just because of the way that ecosystem runs. So as a segue into that, we'll talk a little bit about debt capital. Debt's your friend. We're a huge fan of using debt intentionally and appropriately. Debt is, more debt does equal more risk, but only, the risk can be pretty, in an insurance brokerage, if you use debt appropriately, the risk can be pretty low. So when we say debt your friend, senior debt is generally a very low risk capital option for insurance brokers. Default rates are very low. We talked to a number of our lending partners, and we haven't heard of a major default in traditional middle market insurance brokerage. And there may be some out there, but it's not common. There are lower costs. You're talking interest rates that are generally a few turns over whatever the lending rates are. They do have higher covenants, but they tend to be decently covenant light compared to other debt structures in the market, because our cash flow based loans are not asset based loans on average. There's a large number of firms that specialize in the space. So when you're talking about capital needs of sort of, 3 to 4 times EBITDA max, senior debt is generally the way to go for that level of capital need. Now, on top of senior debt, there is another layer, mezzanine debt, and that's debt in and above that sort of 4 times EBITDA ratio range. So let's say you're 10 million EBITDA, you've already borrowed your 40 million from senior banks, you need another 30 million. It's possible to get that from non-equity holders. Now, what I said earlier starts to apply here. The mezzanine layer is difficult to get access to if you do not have a private equity sponsor. There are firms out there, but it's very expensive, approaching equity level costs. It is pretty low covenant because they're making up for it in the rate. And so it is, a little bit easier to get. There are a lot of convertible debts that straddle that equity and debt capital stack. So there are loans that convert to equity at certain returns, or if you don't hit certain returns, and again, it's all part of the cost. Similar to preferred, we didn't say this, we should have. Preferred equity has a common, various forms. And what we say is, when you've read one preferred agreement, you've read one preferred agreement. So no one should ever take on preferred equity without talking to an expert like us, because there's a billion ways those things can be written. Anything above a senior debt level is very similar. When you get in the mezzanine debt level, There's a lot of esoteric structures, and when you've seen one, you've only seen one because it can get very flexible and it's very expensive. And this is that higher risk debt that generally, if you're exploring this and you haven't explored any sort of equity structure yet, we should have a conversation because there's a minefield here. So analysis of the debt capital option. What are the benefits? It's materially less expensive, at least in the senior debt structure. The mezzanine still tends to be a little less expensive than equity. You maintain control, you have tax deductibility with interest. If you are wildly successful, you don't have to share that success with the bank. They're only getting what you've agreed to pay them. And you have predictable repayment obligations. The drawbacks is if you over restrict yourself on leverage, you can get in stuff where you have covenant defaults, you can start to lose control of the business, you could be forced to sell, you could be forced into bankruptcy. Again, with the brokerage, it's not common, but it's all possible. You have personal guarantees for smaller firms that are not institutionalized. So there's a world in which you could lose your personal assets like your house. And the more debt you take on and deploy, the less you can take on incremental debt until that debt's paid down. So this is something that doesn't infinitely scale if you're not successful. So there are drawbacks, there are risks. Where versus equity, if the whole thing falls apart, the equity holder, they rode with you, they're taking the same risk as you. When to use it? It's very ideal for the average insurance agency that's going to do a deal every few years, that's going to do some shareholder buyouts that are not incredibly large, and it's very for lower predictable initiatives that you're taking. Like if you need to take out a loan to put in a new technology system, if you need to take out a loan to you want to bring on a bunch of extra producers, and you want to fund some of that with a loan. We wouldn't recommend funding the whole thing necessarily, but we could talk through that, and you could use a little bit of debt to do that to also offset your cash flow so that shareholders still get the right returns. There's a number of things where debt for our average client is the right equity option.
One thing that's very important to think about as it relates to debt is when not to use it. And there's one very critical reason not to use it. Do not use it to fund your normal operations.
Right.
I've seen this many times where people are trying to fund payroll or pay their facilities rent or whatever else, normal expenses that should just be covered by the monthly returns or monthly receipts of your typical insurance clients. Now, we understand the use of something like a line of credit that manages the heaps and valleys that you might have just in terms of normal cash flow in your business. But that's different than using debt to literally fund your ability to cover payroll or your ability to pay rent or things like that. That should not be the case.
Yeah, and that type of debt, that wrong use of debt tends to be much more expensive than the debt that we would recommend because the banks recognize that your business is not being run correctly. It is a low capital intensive business. You do not need a lot of equity or debt capital to run an insurance agency. So when we talk about bringing in outside capital, it should be largely for growth initiatives or cap table restructurings among shareholders as shareholders come on and off. How do you optimize your capital structure for long-term success? And we said at the beginning, this is an iterative process. You should be evaluating your shareholder models, your shareholder plans, how you're deploying capital, what growth you're getting. You should be evaluating that every year at a minimum, and likely a little more often than that. You should be thinking about, okay, how am I spending money? What is the return on that capital? What are we getting for it? Like, how do we compare to the returns that the markets are providing? And those are all things that our clients have access to that we can work with them on as they're trying to think through how they should be growing their firms. So you need to regularly assess capital needs. You need to think about how you're funding things. Do you have the right balance? I've had a client recently that brought on in the early stages, couldn't take on debt, brought on some equity partners to help them grow. And now he's using debt to buy those equity partners down so he can reduce his overall cost of capital long term. Those are the type of things that you can do. How does it impact your company valuation? All these things, like bringing on equity doesn't affect the valuation of the firm directly necessarily. Hopefully it gives you a higher return, but it does dilute the existing shareholders potentially. And bringing on debt is a dollar for dollar reduction in the firm unless you get a return the day that it comes on. So These are all things we have to talk through, and goes back to thinking about what's your ROI as you put out a capital. And then you got to be flexible and understand that making statements like you're never going to do something, like you might be able to say, I'm never going to borrow to fund the operations of my business, which is the type of debt we said not to do. But in general, you need to have an open mind about how your firm evolves. Fundamentally, what drives a lot of this is equity has to change hands over the life cycle of a business. No business lasts 100 years without multiple owners of it, because none of us live that long. So you just have to think through the fact there is a reality that your cap table and your structure will change inevitably. The question is, do you control that because you've been intentional or not?
And one of the things that this all starts with is just an intentional strategic planning process. Are you sitting down and setting a vision for your organization? Are you putting projections together for your growth, your expected growth, how many people you're going to hire? Are you going to do acquisitions, or are you going to stand up de novo offices in other regions or other cities? All of those things might require capital, and so then you need to work backwards and sort of reverse engineer your timing. When do I need to start seeking the capital in order to effectuate an acquisition 2 or 3 years from now? Those are the types of questions that should be embedded in your strategic planning process. And you really should build the habit as an organization of doing strategic planning once a year with your key leadership individuals.
So we mentioned this concept earlier, and I want to bring it back to the forefront. It goes into a through line of every single one of these sessions on increasing equity value. Human capital is capital. In an insurance brokerage, you do not buy machines, you don't buy fleets of cars, you don't buy oil wells or rigs, you don't have massive capital assets that you're depreciating and hoping to get a return on. What you do is you hire talent, you train talent, you deploy talent, and that talent provides services to your clients and your niches and the things that you've been built to serve, and it returns value to the firm and to shareholders. And this is why it's so important in these human capital intensive businesses that there is some sort of partnership model, whether that is performance-based incentives through excess comp, which is again a lien against equity holders, whether that's synthetic equity programs that align people longer term, long-term incentive plans, whether that's a deferred compensation plan, like 409A governed plan that might be book ownership, equity. It could be an equity right. It could be, accrued bonuses over a long period of time that get paid out in the future, whether that's stock options or warrants for individuals where you're not sure if it's going to pan out, but you want to give them some optionality that if they perform well, the firm performs well, there's some upside to what they bring to the table, whether that's restricted stock units where they don't have necessarily voting rights and there's vesting schedules attached to it, and this is a path to real ownership, whether that is not even ownership in the firm, but old fashioned, you have an ownership interest in your book, and here's the calculation related to that. And at the time of a transaction or retirement, here's what you can expect to get paid, and here the payment stream is. We believe that to grow a professional service organization, whether in wealth, insurance, accounting, and any other human capital, any ancillary business, human capital is capital, and the higher performers within your talent stack need to have alignment with the equity value of the firm.
This is truly becoming an expectation out there in the workforce. So your typical producer who's hunting for a job is looking for a place where they have a path to ownership. That's extremely common these days.
And every single high-performing firm has some version of these long-term alignment structures. It might take different forms in different organizations, but everyone has some sort of carrot and golden handcuff, for lack of a better word, for high performers that is based on long-term value, not necessarily based on the last 12 months of their performance. So expert guidance matters. We have read, as a firm, thousands of these types of plans. We've read thousands of producer agreements. We've seen every kind of capital structure you can imagine. We've seen every kind of preferred agreement you can imagine. We talk about with our clients, this is what we talk about with our clients all day long. How do they grow their firms? How do they align their talent? How do they deploy their capital? How do they evaluate a transaction? How do they evaluate technology? How do they evaluate going to a new market? How do they evaluate going to a new line of business? How do they comp the new line of business? What are the revenue characteristics? What are the risks? How does the market view it? This is what we do in, day out. And there are minefields and issues all over the place that are common, and we can see them right away because we see it all the time. So before you go out and chart your growth, or as you're doing it, we recommend working with us to say, okay, if I'm going to go about and deploy capital, I'm going to broaden ownership. I'm maybe going to take on equity or debt. Maybe you decide, you know what, the right thing for me is I own 70% of the firm. No one can buy it. I can't perpetuate it, but I want to continue to grow and add options. Maybe I want to partner with a strategic. All of that is where we help our clients think through and accomplish their goals. Our lens is to provide information to our clients to accomplish their goals, to maximize the value of the equity they own in their businesses.
And sometimes these aren't necessarily projects. We're happy
Right.
to, and that's another thing, maybe we shouldn't say it, but we don't really bill by the hour. So you could always just give us a call and say, hey, I'm evaluating this and I have some questions. Maybe can I bounce some of these ideas off you? Please feel free to give us a call.
Yeah. Our goal is to build trusted advisor relationships with insurance brokers, wealth firms, and we don't do that by nickel and diming for advice. We build that by actually building a relationship and providing value. Selecting the appropriate capital structure. Let's revisit some of the things that we talked about over this webinar. You need to assess what your current capital structure is. Is it just 100% you? Is it all your money? You need to think about what are you going to do to grow? Is there an agency you want to buy? Do you need to hire producers? Do you need to refresh your tech stack? Is there lines of business you want to get into? What are the things you want to accomplish? Then you need to think through what are the risks associated. If I spend the money to do the things I want to accomplish, what is the risk associated with that? What do I return on the money I'm going to spend? If you hire somebody as an owner, 100%, you're spending 100 plus $1,000, maybe 150,000, you put in all recruiting costs and everything else to bring on a person. That's your equity capital being invested in that person. What's the required return? How do you think about it on individual hire? How do you think about it when you hire multiple? Generally, we do recommend thinking about it over a number of hires. Any one hire can go bad. If you have a good pipeline, it tends to reduce the risk. You got to think through how you're going to fund it. Are you paying for it out of the cash flow agency? Are you paying for it on cash on the balance sheet? Are you going to take on debt? Do you have a line of credit? Are you going to seek an equity partner? And then you need to partner with experts. Fundamentally, after you think about these things, or even as you're thinking about these things, work with advisors that understand the pros and cons of how you spend the value of your firm to increase its value, to maximize the potential outcomes.
Yeah, partnering with experts is important. If you go out and seek a private equity partner, they will have their experts that they are that are relying on. You will want people that you are relying on, both in your tax, in your legal, and in your business interests. They have those and you have those. Same with anybody who's providing debt. They have advisors on their side, whether it's legal or tax or business related. So keep that in mind.
Just the final thing on us, we're here as a strategic partner. And again, happy to pick up the phone, talk through these issues, and to help you think through your future.
Thank you.
Thank you.